I'm in discussion with Shaun le Roux, fund manager of the PSG Equity Fund, and we're unpacking what goes into managing an equity fund on a daily basis. So it may come as a surprise that it's not simply a matter of selecting the best performing equities and blending them together in a portfolio. The process is much more nuanced than that. And despite the volatility and ups and downs of the stock market, the PSG Equity Fund has proven its mettle. As at 30 April 2024, the fund is top quartile over 1, 3, and 5 years and since inception. So Shaun, to kick us off, maybe you can just remind us of the role of an equity fund in the portfolio and who should be investing in this kind of fund.
Thanks, Audrey. An equity fund, or equities in general, are orientated at an investor that wants to grow their capital and grow their capital well ahead of inflation. And equities can do that. If we talk about the PSG Equity Fund, over the last 22 years, it's grown capital by 15% per annum for more than 2 decades. And if you think of inflation, it's actually on average less than 6% over this period. This fund has beaten inflation by 9% per year. So if you put R1 million into the equity fund in 2002, that's now more than 22 million rand. And this is what equities can do. But in order to achieve that, that all sounds wonderful, but you also have to remember that equities go up and they go down. And in 2008 or 2020, the market can go down by 30 or 40% in a year. So an equity fund is orientated to investors that have the capability to stomach the ups as well as the downs. And if you can be in it for the long haul, further out you go, the better the picture looks.
So can you remind us, in terms of PSG Asset Management's investment philosophy and process, how do you go about selecting equities?
We have a long established investment process. We're a bottom-up asset manager, which means we're looking at individual investments on their merits, individual stocks, and trying to choose the best stocks. We're also long-term investors, so we're prepared to be patient. What we use is our 3M process, and this is a structured way of looking at stock markets right across the world and trying to come up with ideas that are going to give our clients the best chance of growing their capital without taking on too much risk. The process we use, we refer to as our 3Ms. Specifically, we're referring to the moat, the management, and the margin of safety of a particular security. The moat being, does it have a competitive advantage? We're asking the question around, is the management team going to do the right things for shareholders? And if we can buy at a margin of safety, we not only give ourselves a lot of upside, but we typically protect against the fact that we don't want to lose our clients' capital if things go badly. Importantly, we like to do our own research, and the team that I'm part of will be looking at the stock market and saying, is this a good idea for our clients at this point in time?
So since PSG Asset Management follows a globally integrated process, I can imagine that you must find many opportunities when looking at the entire investment universe out there. So how do you weigh these up and trade them off and decide which shares finally to incorporate into your portfolios?
Yes, that's important. We've been investing directly offshore for more than 16 years now, the same team. So we've got a lot of experience in this space. It's going to be very, very important to have an offshore capability because, as most people will know, domestic unit trusts in South Africa can invest up to 45% of their clients' money directly into offshore stocks or bonds. We've been doing this for a while. We use the same process, that 3M process I told you about. We can look into any market, and this experienced team of investment professionals can conclude on where are the best opportunities. Are they in the US? Are they in Europe? Are they in South Africa? Are they in other emerging markets? We can compare stocks across different markets and see which offer the best returns, which offer the most risk. And more importantly, we can blend the particular stocks in a way that gives us the best outcomes but manages risk at the same time.
So equity funds typically sit at the top of the risk spectrum, and therefore it might come as a bit of a surprise to investors that there are risk considerations in terms of how you manage these portfolios. So can you give us an idea of how you approach risk management from an equity perspective?
Yes, and that's also very, very important. So I spoke earlier about picking stocks around the world, and one of the key things that we are looking for is we're looking for diversification. So we would like to diversify across different geographies. We'd like to diversify across different sectors and not have all of our eggs in one basket because things do go wrong. That's a very important characteristic of a blended portfolio. But what we also very specifically seek out as part of our investment process is stocks that we could add to our buy list that have different and in some cases idiosyncratic characteristics. What this means is these are stocks that aren't beholden to the global economy. A good example right now would be we have healthy exposure to global brewers across our funds. We think some of these names are not economically sensitive and attractively priced and look very good in a portfolio because they will be going up at times where other stocks might be going down. But in particular, if we look into the current set of geopolitical and macro conditions, we see a very crucial role for something like gold and something like energy. We think both of those have the characteristic to protect portfolios in the future at times where other parts of the portfolio might start to struggle. So we take all of these things, we take our global buy list, we look into the fund mandate, and we consider the investments that are going to provide protection to the portfolio, and we blend those in a way that gives our clients the opportunity to get excellent returns with a careful eye on risk at the same time.
So Shaun, I think you touch on one of the key challenges of managing an equity fund, and that is the cyclicality and volatility that we see in markets. Now, looking at the current market that we see with plenty of uncertainty and volatility mixed in there, where are you finding opportunities?
Audrey, it's very challenging at the moment. In fact, I would argue one of the more challenging times of my investment career. On the one side, as South Africans, we're grappling with a very fluid and uncertain political environment. And on the other side, we have an American market that continues to power to all-time highs. But that's taking place driven by a smaller and smaller contingent of stocks. The ratings or the prices being paid are going up to very high levels. And we're seeing clear evidence of highly speculative behavior. And these are things that worry us, and our clients have little to no exposure to the US. But when we look on the other side and we look into markets like South Africa or markets like the UK or Hong Kong, we see clear evidence of stocks that are deeply out of favor, where using our 3M process, we can buy good companies really cheaply. And if we buy them well, and if things aren't absolutely disastrous, our clients should do very well. And South Africa would be a very good example of that currently. So we see this environment where differentiated investors that are prepared to look into parts of the market that are unloved, where there's a lot of fear around, we think good things are going to happen in the future. And we think these are the kinds of environments that have given rise to that 15% per annum growth from a fund like the equity fund. So we're really excited about the future, but we expect the waters to remain choppy. And we recommend that investors be prepared to be patient, and good things should happen.
Shaun, it's been fascinating. Thank you so much for joining us today.
Thank you, Audrey. I enjoyed that.